Okay, let's try this from a new country. I am now in Costa Rica. I arrived here late Thursday night, set up an office in one of the upstairs rooms that has a bunch of AV equipment in here. So if you hear a hum, that's what it is. I'll have to do the video and determine whether or not I can stay in this room. If it sounds with a bit of an echo, my voice sounds with a bit of an echo, it's because the room is not quite full yet, so there's not a lot of sound dampening, and it's a big wall, two big walls of windows. So sound just bounces off that. I don't know if I'm in the right room for this, but here I am. Let's begin. What a week for rates, especially Friday. Friday I really couldn't check in with the market, only at the end of the day, and I saw TLT up almost $2, $1.87. I think, what a day. So I had to review Powell's comments because I think that's what caused a lot of it. And I think there was one part in there that really did it, is when he talked about inflation having really come down, dramatically come down. That right there sort of tipped his hand as to, I think, what the committee is thinking. They are done. Money market rates coming down. Look at the 1 year down 22 basis points in the week. The 2 year down 36. And we look at the difference between the 1 month and the 2 year, 100 basis points in there. And you have almost full rate cuts across all of the tenors here. The 7 year, 29 basis points, a 25 basis point cut on the 10 year, 21 on the 20, 20 on the 30. That is something else. Inversions, the 2 to the 10 will uninvert before the 3 month to the 10 year, because the 3 month will reflect monetary policy, but the 10 year will start to reflect the anticipation of monetary policy. The 3 month won't build too much anticipation into that. So we should see that, the money market, the capital market, continue to invert, to go deeper into inversion, while the capital market curve, the 2 year to the 10 year, heads towards the flat line. It decreased 11 basis points, so inverted by 34 basis points. The 5 to the 10, 2 to the 20, 10 to the 30 segments are all positively sloped. 508 days on that one now. The Canadian, still negative 64. Canadian GDP, third quarter GDP came out this week, negative 1.1% on the quarter. The beginning of a recession here. The 3 month of the 10 year negative 161, the Canadian negative, the US negative 121. Deeper inversion again, because the 3 month will hold very close to where the target rate is, whereas the 10 year will start to build in expectations of what the future will hold. The balance sheet continues to run off, another $12.5 billion. It's down to $7.191 trillion. The overall balance sheet under 7.8 trillion, 7.796145. This is the lowest level. I looked at the balance sheet and went backwards to find the next level. It's April 21st of 2021. It's the lowest level in over 2.5 years on the Fed balance sheet. The drop week over week was 14.669 billion. The runoff of the balance sheet was 12.56 from the SOMA. So the balance sheet also had a net runoff too of another 2 billion. The overall net, if you look at where the SOMA is and where the balance sheet is, this was a result of quantitative easing. If we just look at the Fed balance sheet and take out all of these purchases, it's 618 billion. Money market funds increased 73 billion. That shocked me when I saw it, until I saw the reverse repo. Reverse repo fell a lot, so we would naturally expect institutions to see a big increase. 71.13 billion of that was from institutions. Retail increased, government just 93 million, prime 2 billion. Government here 71.44, which is almost all of the increase from institutions. Prime was just 158 million. Next, FOMC, now 10 days away. No change, 98.8% on no change, and just a small percentage on the increase, and that just could be, if the market were open another 5 minutes and different positioning, that could have gone to zero. 98.8 versus 95.5. If we head all the way over to June, this is the bigger story. Rates staying the same or going higher. Only 1.6% probability priced into the Fed funds futures that rates will stay the same or go higher. In fact, there's nothing on the higher. So the 1.6 is purely no cuts by the June 12th meeting. 98.4% probability of at least one cut. The weight of it here is down around 2 to 3 cuts. Versus 70.8 the week before. What a difference a week makes. Went from 71%, roughly 71% probability of at least one rate cut to almost a certainty, 98.4% probability. Incredible. This is a week for labor. For JOLTS report, 2 days. ADP, 3 days. Q3, unit costs, unit labor costs and productivity we get in 3 days. This is the big one here, unit costs. If you have increased productivity, you will have decreased unit costs. That is deflationary. It is when you have rising unit costs. That is inflationary. Decreasing unit costs means that with the increase in productivity, instead of spending $1 million to make 100 units, you're spending $1 million to make 120 units of something. So the other 20 are produced for the same cost as the original 100. Your cost per unit decreases. There's your deflationary potential in there. Payrolls in 5 days. And for the Canadian watchers, Bank of Canada, 3 days, and I expect no change. The interesting question is, would I expect a rate cut? Being that inflation is coming down in Canada, not as fast as the Bank of Canada would like, but that you do have a whole quarter now of negative GDP, negative 1.1, the same quarter in which the U.S., by the way, the restated, the second look at Q2 GDP was 5.2%, not 4.9, increased to 5.2%. So same continent, almost the same type of culture overall. We get our media content mostly Americanized, so it is still very much kind of an American mentality that we have, like call it a North American mentality. But one little line on the continent dividing Canada from the U.S., and you have 5.2% real GDP growth south of the border and negative 1.1% GDP growth north of the border. And here's the crazy thing, 80% of the population live in a small ribbon within 200 miles from the U.S. border. That had the border been just 200 miles more north, we'd all be in the U.S., but just that line across the continent produces that. That's incredible. The effective federal funds rate still holding at 5.33. The 12-month lag still 150 basis points, and I think the Fed is, looking at the lags and saying, "Listen, we've seen inflation really come down," and to use Powell's words, dramatically come down. Those are powerful words coming from the chairman of the FOMC. Oh, and in relation to the labor market, he did mention there is softening in the labor market. That they do see a noticeable softening in the labor market. Wage pressure is abating there. That sounds like a group of people that's done, and they're still they are looking at the lag effect still. So if we think 12-month lag, 150 basis points. Look at the reverse repo here, down to 768 billion, 865 last week, 768 this week, a drop of 97 billion. So when I do these screens in order. So I don't look up the drop in the reverse repo until after I look at the money market funds, because that goes on the first screen. So when I saw the increase of 71 billion after last week's performance, I thought, well, what's going on here? And then I saw the drop, that big drop in the reverse repo, 97 billion in a week. So, okay, well, it had to go somewhere. Okay. This is at 1 day SOFR 5.3. The 1 month to the 6 month are all higher. So being that there is plenty of supply, the question is, well, why would 768 billion hang out here at 5.3 when there is supply and it can get higher? So I do expect this to continue its move on the way down. Takeaway from this screen. This is a labor market week. This is probably the big one to watch. Unit labor costs and productivity. I think this matters more than the payrolls number, because if you have very strong productivity and really negative unit costs, you can live with higher employment. You can live with what would be otherwise inflationary pressures if productivity is carrying the day. Real yields, all of them from the 5-year out to the 30, and the 5-year forward, which is a 5-year and 10-year, the gap between the 5 and the 10. What they imply is what the 5-year forward rate would be. All of them dropping. Look at that 5-year, 26 basis points, the 7-year, 23, 10-year, 21. That's a full basis point cut. And those are real. That's a real interest rate. All of them just sitting above the 2% mark. If this continues, next week we should see a 1 handle on all of these. And our inflation rates, the break-evens, dropping as well. Here's your big story, I think, if you're into the forward curve on Fed Funds Futures or SOFR. Last week, bottoming out at 5.365 for February, now bottoming out in January at the Fed Funds rate, 5.33%. So some movement in the February futures here. Go out to June. Last week, 5.13 was the implied rate. Now it's 4.835. That is a drop of 30 basis points. And the last week, the market, or at least the futures curve, was pricing in roughly 1 rate cut from the end of February to the end of June. You can see here 5.365 to 5.13 is about 23 basis points. It is now a 50 basis point spread that by the end of June, the market is saying, no, not 1, probably 2 rate cuts. In 1 week, we went from 1 to 2 rate cuts. And then going from there to the end of the third quarter, to the end of September, another 36 basis points here. So at least 1 rate cut and a bit more. And then the SOFR curve is 125 basis points. By the way, if you use the Fed Fund futures for December, you'll get the same inversion, 125. We're going from 4 rate cuts in 2024 to 5 rate cuts, at least implied, 5 rate cuts. 2 by the end of the by the end of the second quarter. And there is some thinking that March might be the live meeting. If you use the March meeting, that it might be the live meeting. I don't know. I don't really think so. Q3, let's say that is 1 cut, and Q4, based on the 125 to get that's 39. So 1 to 2. So somewhere in here, in the second half of the year. 3 rate cuts, 5 rate cuts next year. TLT had a nice week, up 3.55%, and there is the Powell effect on the words dramatically. I think it was either dramatically or significantly come down, but he said the same sentence twice with a different adjective. We've seen inflation really come down. Dramatically come down. It was either dramatically or significantly, but he made a point of repeating that. So I think that really means something. 3.55, SPY 0.77%. I've made no changes to my positions. Implied volatility percentile, 33% on the 13, pretty much where it was. 53 up to 56 and 32 up to 35. Probably some call buying here that's putting more implied volatility in there. Okay, mortgages, 7.22%. And if you're hearing a kind of a buzz behind me in the video, I'll be silent for a second. I don't know if you can hear that, but there's a wall of electronic equipment that controls the whole house in this room, and it just lit up and started whirring. I don't think I'll be able to stay in this room. I'll have to find another room of the 853 rooms in this house to put my office. 7.22%, a drop of 7 basis points, but I think this is 5 weeks in a row that the 30-year fixed rate mortgage has fallen. Spread really sticking where it is here, only down 2 basis points, still at 285 basis point spread. still, in my opinion, representing an incredible buying opportunity on MBS. Agency up 3.9, Annaly up 5.41. Look at ABR, 10.71. What happened over the course of the week? 4 more Form 4s. The CEO and the CFO plus 2 others are buying. Now, the other 2 were small purchases, but these are employees putting their own money at risk on this. So this is not ABR buying back stock to make a signal to the market. These are insiders putting their own money at risk. So if anyone would have a view on what the future holds for ABR, it would be the insiders. At the very least, we would expect that, well, if there was something to look out for, they would not be buyers. Maybe they wouldn't be sellers. They don't want to, give a signal, but they certainly wouldn't be buyers. So that is significant. And Fitch affirmed their ratings, and usually it's just an affirmation with a neutral on it. So you have a rating with a neutral. Positive outlook, a positive outlook. So I think the damage from the short report is pretty much over. And another bogus short report written by people who don't understand what they're talking about. Credit spreads continue to shrink. Housing, what did we get last week? Not good data overall. Well, I shouldn't say not good. It's sort of mixed. And I'm going to show you something, a presentation that was done at an investor conference from one of the Canadian REITs. With some really great population data, both for Canada and the U.S. It becomes clear why rents are where they are and why home prices are just not giving way to the higher interest rates. New home sales for October in the U.S. down 5.6% month over month. And in Canada, you see the same thing. Between September and October, activity just dropped, significantly dropped. House price index. Now you're going back to September, of course. The October one will be interesting to see. House pricing index for September up 0.6 month over month, up 6.1% year over year. Case-Shiller, which is a more broader measure, up 3.9% year over year. Up. I want you to reflect on that a minute. Up 3.9%, 0.2 month over month. Mortgage applications up 0.3%. Pending home sales down 8.5% year over year, down 1.5. So when it comes to activity in the market, it is low. But when it comes to the price is not reflecting the drop in the activity. Last week, we got US PCE for October. But we also got a whole bunch of inflation readings from different parts of the world. So I thought, let's take a tour. And just look at how it's coming down, and it sort of matches what Powell was saying, significantly coming down. Australia CPI 4.9% for October. The month before was 5.6%. Spain, month over month, this is for November. This is a preliminary reading. The ones you see for November down here are preliminary. Negative 0.4 versus 0.3 the month before. Year over year, 3.2 versus 3.5. The core, 4.5 versus 5.2 the month before. Those are big drops over 1 month. Germany, 3.2 versus 3.8 year over year. Negative 0.4 versus 0 month over month. Negative, that's deflation. Deflation here in Spain, in Germany. U.S. third quarter GDP. If we look at the GDP, the core PCE measure in third quarter GDP, 2.3% versus 3.7 in Q2. Look at that. That's quarter over quarter. France, month over month, negative 0.2. Euro area inflation, month over month, negative 0.5. So for France, 3.4 versus 4 year over year. The euro area, 2.4 versus 2.9 year over year. They might be done. ECB might be done. Look at that. France, Germany, Spain. The core for euro area, 3.6 versus 4.2. That is a big step down over a month. Italy, Negative 0.4 versus negative 0.2 month over month, 2 months in a row, and accelerating. 0.8 for Italy inflation, 0.8 versus 1.7. Look at this, negative 0.4, negative 0.5, negative 0.2, negative 0.4. But then again, economic activity there is much slower. US PCE, the core year over year, 3.5 versus 3.7. Small step down, but again, you're dealing with 5.2% real GDP growth. You're not getting that in the Eurozone. Month over month, 0.2 versus 0.3. 0.2 is consistent with 2%. Price index 3% versus 3.4. This is core. This is the full. This is headline. 3% versus 3.4. Month over month 0 versus 0.4. Both the core dropping and headline dropping. Let's look at an investor presentation that was put out by Canadian Apartment REIT, Cap REIT. 80% of their residential units are in Canada, 5% are in manufactured home styles, commonly called trailer parks, and 15% in Dutch residential suites. Look at their occupancy, 98.4%. Mostly concentrated in Ontario, 45% in the Toronto area, 6% in London. And then they have a showing in almost every province. Let's get into the interesting slides here. So this slide here, this dark blue that you see dropping into 2022, this is natural population growth. This is if you take away all immigration of any form whatsoever, whether it be permanent or temporary, and you just look at the population, births and deaths, it is still growing, but you can see that its growth rate has been dropping significantly. The gray area is net immigration. You can see it makes up a big difference here. And then you have net non-permanent residents just skyrocketing. This, I think, is super interesting. This is G7 population growth rates. The solid bar is 2010 to 2022, and the hashed bar is the forecast for the next 12 years, 2023 to 2035. Canada has had the fastest population growth rate from 2010 to 2022, and the fastest, or at least forecasted to have the fastest growth rate over the next 12 years. Look at Japan down here. For 2010 to 2022, it has been shrinking and expected to shrink even more. Same with Italy, same with Germany. This is why Japan has a problem with deflation, is because it has a shrinking, aging population, and they tend to spend less. And when you have a population that's shrinking, you have a housing situation in which you have more and more housing available for everyone else, so it's putting downward pressure on those prices, and that's expected to continue. The U.S. is number 2 here in terms of how much its population is expected to grow over the next 12 years. Canada and the U.S. Canada by far outpaces all the others. And this is homes per capita. Canada, 424. This is per thousand population. 424 homes per thousand. France, 540. Look who's number 2 here. 427. In terms of the lack of housing available for the population, Canada and the U.S., which is why the U.S. home builders, I think, have at least a solid decade ahead of them. I'm going to show you another screen about how much housing is needed in Canada just to close the gap. The U.S. is not that far behind. Most expensive housing market in the G7, Canada, followed by the U.S., 137, 135. And when you look at it in terms of the available housing per thousand, it starts to make sense of why they're so expensive, is because you have a lot of people that need them and not that many of them. Canada's growing housing supply gap. This long blue bar over here is population growth. This smaller bar here is housing completions. And you can see going back to 2014, 2016, if you take out the pandemic year, you had this massive increase. 2016 is the year the Liberals got in. And immigrants, new immigrants to the country, tend to vote Liberal. So to stay in power, Justin Trudeau figured out very quickly, I'm going to import the votes I need to stay in power, and that is exactly what he's done. Look at this, just skyrocketing straight up, and here you are, without any concern for can they even afford a house when they get here, and there's no place for them to live. This is the additional population per housing unit built, 4.2. So basically what it's saying is that for every housing unit on the market, Canada's population increases by 4.2 people. So that the average density per house, per new house, would have to be 4.2 people or higher to start solving the problem, which is what you would expect to see when you have more Eastern style populations. They tend to be multi-generational in their housing. It is not uncommon to see houses with 8 to 10 to 12 individuals living in them. The problem is that the cities in North America are not designed for that kind of neighborhood density. So if you take a particular neighborhood in Toronto, now I lived in Brampton for a couple of years, which has a heavy Indian presence there, mostly from the state of Punjab. And the average in each house, I'd say, was 7 to 8, if not higher. The schools in the area were designed for a traditional North American population, which is about 3 to 4 per household, and so were the roads. The size of the roads were built for that. So if you are ever in the Toronto area, it has a very large Eastern, and as opposed to Western, Eastern philosophy type living arrangements where multi-generational is quite normal. Well, what you get is density, huge amounts of density, such as Toronto. Almost any time you enter Toronto, you are entering a parking lot. It is difficult to navigate in that city, but the streets, the amenities, the schools were never designed for populations with that kind of density. So if you have this trend continuing on, you have a big infrastructure problem as well. You're going to need more highways. You're going to need wider roads. So it's not just a matter of let's increase the amount of immigration. You also have to increase the amount of house building unless you start to dramatically increase the amount of infrastructure that you add as well. Homeownership fundamentals driving demand. Tenant house price index 6.6%. Median household income down here 1.4%. 2-bedroom average monthly rent 2.8. You can buy a house. Look at the way housing prices have grown. Look at the way incomes have grown at 1.4, or you can rent. Really makes the case for renting. This, to me, is an extremely powerful chart. This overlays the immigration growth, both permanent and temporary, with housing completions. So the dark lines here are housing completions. You can see in Canada, right around 200,000 is, 200,000 is a good year for housing completions, but 175 to 185 is quite normal. Hitting up to 200 those are good years. And it's expected to increase to a little over 200,000, which for Canada would, if you can keep that going for 2025 through 2030, represents probably 5 to 6 of the best years of additions to the housing stock that Canada's had, going all the way back to 2000. But this gray bar here, what is this? This is additional annual requirements to restore affordability, and this dark line here is population growth. Look at the difference. Canada's never, ever, ever built that many, and in fact, if it builds the forecasted number here, these little orange bars, these lightly shaded orange bars, if it builds that and maintains that for the next 6 years, that would set 6 years of records, and that is nowhere near what is needed. And going back up here, there's the price of a house in terms of how it's appreciated. Yes, rents are elevated, but look at a 2.8 versus 1.4 really makes the case for Canadian apartments. which is why a while back I loaded up for the money that I can leave in Canada, which is your registered accounts, your retirement accounts, your TFSAs. I had moved them to cash because I got out of all my REITs. I got back into apartment REITs, and it's all in apartment REITs. The one I'm showing you now, Cap REIT, I got in at $40 and I think $40.80, closed at 47 and change. We're heading up to another 85 cents, and it's up 20% over the course of the last month. And this, I think this really makes the case. This chart here, I think is powerful. Look at the Canada and US. Is it any surprise that they're at the bottom here in terms of the amount of housing per thousand, and it translates into the top here to be the most expensive markets, right? And again, if you compare it with how housing prices have increased versus rents, really makes the case. Let's talk about GM. Big story there last week. They had an investor update day, I think on Thursday, to update their 2023 guidance. And Mary Barra started off with, first of all, let's just say we are disappointed with our Ultium performance. Ultium is their EV platform. Disappointed with their Ultium performance. We're going to increase our dividend 33%. Sounds like a lot, right? But it was only 9 cents a quarter. Now it's 12 cents a quarter, 48 cents a year. This was huge, a $10 billion accelerated buyback. And they had $1.4 billion remaining from their previous $5 billion buyback that they're going to use opportunistically. They didn't call this accelerated. They're still going to use that opportunistically. They got a market cap of just shy of 40 billion. 10 billion represents 25% of their market cap. And I had said this about a year ago about GM, that given the low multiple it has, you could basically buy all of GM, and within 4.5 years, just from the free cash flow, you'd get all your money back and you'd still own the company over the next 4.5 years. So I get that the market may be pricing out the end of internal combustion and saying, oh, well, it'll have zero residual value. All those assets will have zero residual value. But that's going to be years in advance, years into the future before ICE disappears. It's not going to be in 4.5 years. Why is somebody not picking this up and paying themselves back from the cash flow? And I think GM has figured it out, saying, why don't we just do it? $10 billion buyback, 25% of the market cap. So if you think of GM before the announcement, with a before this happened, $28.50 share price, divide that by 3 and multiply by 4 to get to what buying back 25% of your stock would be. You're somewhere around $40, just a little under $40 a share. And if you add in the 1.4 as well, you get to somewhere around $41, $42 a share. Keeping the same market cap, saying GM is going to be worth what it is worth now. It'll have a market cap of 40 billion based on a multiple of cash flow. And you just reduce the share count. You can get to a share price of $40 to $42 at the same market cap. And this is an ASR, an accelerated stock repurchase. Accelerated, which means they're not doing it opportunistically. The 1.4 will remain opportunistic. Well, this comes at a cost. Let's see what the cost here is. Cruise. It's going to be less about expansion, more about safety and trust. So Paul Jacobson said significant reduced cash needs. And he was pressed on that again, to say, when you say significant, what's it going to be? And he didn't want to give a number, but he said later in for one of the questions, hundreds of millions of dollars less going into cruise. Now, they still supported cruise. They still said, we still own that company, or at least 80 some percent of that company. We're not abandoning it, but for the next little while, it's going to be less about expansion and more about safety and building trust. They got a pullback in CapEx, battery electric vehicle and cruise. We just talked about cruise. They pushed back their EV truck capacity to late 2025 that they they were looking for to hit capacity sometime in 2024. They're going to delay the opening of a plant so that they won't have that capacity till late 2025. They're going to continue with the Bolt. They were going to discontinue the Bolt and introduce a new vehicle in place of it, but instead they're going to continue with the Bolt, and over the life of the other vehicle, $5 billion less in capex will be needed by staying with a vehicle they already have experience and volume with. Talked about the share price. She said share price has been disappointing. That even looking at the analysts' consensus price target of $42 a share, we're 30% below that price, and just sort of lamenting, the market's not giving us any kind of respect whatsoever. She made a mention of, yes, our share price has been disappointing, and I think this is what they're going to do up here with this buyback. I don't think that'll be the only one. I think if the share price continues to disappoint, which I don't know why it would suddenly start being a massive winner, I think it'll continue to disappoint. I could see another share buyback, another significant share buyback. Boeing did this. They bought back so much of their stock, they ended up with negative equity because they had bought back so much of the stock. They look like a hugely over leveraged company. If it is that cheap, why not buy it back if it is that cheap? And that's what they're doing. As far as the union effect, they said it's going to add $500 to the price of a car in 2024, and over the life of the contract it'll add $575 to the price of a car, and it will add $3 per kilowatt hour to battery electric, offsetting union charges. Fixed cost reduction should be fully implemented by the end of 2024, getting rid of some non-union staff, reducing some of their marketing expenses, and some overhead reductions. And the effect will be material in 2024. So starting next year, Q1, Q2 of 2024, they're saying you should see some material improvements there. And that is how they're moving to getting, we'll see on the next screen, the increase in free cash flow and supporting a $10 billion buyback. Okay, this is from their slide deck for their investor update. Page 5 for GM North America. Unifor is the Canadian union, UAW is the US union. They give you where the impact was. Strike impact, 1.1 billion, and total incremental cost of 9.3 billion over the life of the contract, and a 5-year contract here, and you can see how it's going to increase into 2027. In 2028 drops because the I think contract ends end of the summer in 2028, so you don't get a full year in there. Average vehicle cost impact $575 over the life of the contract, about $500 in 2024. 23 guidance, revised guidance. Two things I want to point out: the EBIT, adjusted EBIT. Previous range was 12 to 14 billion, dropped to 11.7 to 12.7. That is some of the strike impact that is in there. And if we go out to auto free cash flow, previous range was 7 to 9 billion. Look at the jump, 10.5 to 11.5 billion. So the $2 billion in overhead, fixed overhead, is probably already showing up in there. A pullback in the amount of money heading to cruise, a pullback in the amount of money that would have been earmarked for a replacement for the Bolt, and a slowdown in opening their new truck plant, their electric vehicle truck plant, and pushing that capacity into late 2025. From 7 to 9 billion to 10.5 to 11.5 billion, there is free cash flow. There's your stock buyback sitting in there. They narrowed the range for diluted EPS, yeah, I think that was all I needed to show in here. Okay, this is a open letter to the president from 3,882 dealerships Really interesting read. We are auto dealers from across the country who collectively sell every major brand in the U.S. We are small businesses employing thousands of Americans, deeply committed to the customers we serve and the communities which we operate, which is why we are asking you to slow down your proposed regulations mandating battery electric vehicle production and distribution. They lay out quite a case here. Your administration has proposed regulations that would essentially mandate a dramatic shift to battery electric vehicles, increasing year after year until 2032, when 2 out of every 3 vehicles sold in America would have to be battery electric. Currently, there are many excellent battery electric vehicles available for consumers to purchase. These vehicles are ideal for many people, and we believe their appeal will grow over time. The reality, however, is that electric vehicle demand today is not keeping up with the large influx of BEVs arriving at our dealerships prompted by the current regulations. BEVs are stacking up on our lots. Last year there was a lot of hope and hype about EVs. Early adopters formed an initial line and we were ready to buy these vehicles as soon as we had them to sell. But that enthusiasm has stalled. Today, the supply of unsold BEVs is surging, and they are not selling nearly as fast as they are arriving at our dealerships, even with deep price cuts, manufacturer incentives, and generous government incentives. We don't have much to read here, but I think it's important. Each paragraph, is important, I think. While the goals of the regulations are admirable, they require consumer acceptance to become a reality. With each passing day, it becomes more apparent that this attempted electric vehicle mandate is unrealistic based on current and forecasted customer demand. Already, electric vehicles are stacking up on our lots, which is our best indicator of customer demand in the marketplace. They keep coming back to they're stacking up on our lots. Mr. President, no government agency, no think tank, and no polling firm knows more about the automobile customer than us. We talk to customers every day. As retail automotive dealerships, we are agnostic as to what we sell. Our business is to provide customers with vehicles that meet the needs of their budgets and lifestyles. Some customers are in the market for electric vehicles, and we are thrilled to sell them. But the majority of customers are simply not ready to make the change. They are concerned about BEVs being unaffordable. Many do not have garages for home charging or easy access to public charging stations. Customers are also concerned about the loss of driving range in cold or hot weather. Some have long daily commutes and don't have the extra time to charge the battery. Truck buyers are especially put off by the dramatic loss of range when towing. Today's current technology is not adequate to support the needs of the majority of our consumers. Many of these challenges can and will be addressed by our manufacturers, but many of these challenges are outside of their control. Reliable charging networks, electric grid stability, sourcing of materials, and many other issues need time to resolve. And finally, many people just want to make their own choice about what vehicle is right for them. Mr. President, it is time to tap the brakes. You see what they did there? Tap the brakes. It's time to tap the brakes on the unrealistic government electric vehicle mandate. Allow time for the battery technology to advance. Allow time to make BEVs more affordable. Allow time to develop domestic sources for the minerals to make batteries. Allow time for the charging infrastructure to be built and prove reliable. And most of all, allow time for the American consumer to get comfortable with the technology and make the choice to buy an electric vehicle. That last paragraph, I think, is an interesting paragraph in the structure, the rhetoric that they use. You could have done this 2 ways. You could have just said allow time for and then just listed off with commas, but that doesn't have the impact that you want it to have. If you're ever writing something and you have you want to end with some impact, make them separate sentences and repeat the theme. Allow time for battery technology to advance. Allow time to make BEVs more affordable. It has less impact if you say allow time for battery technology to advance, comma, for BEVs to be more affordable, comma. You want to hit each time. So in your writing, when you're writing at the very end, if you want to state your conclusions, rather than do it in a list with commas, see if you can give some, put it in a rhetorical structure like this, because it really, I think, hits the message home. And I think they're right. It isn't ready. I know a year and a half ago when I did the research for the video I had done called "The Ice Age is Far From Over," you get to the inevitable conclusion that, hang on a second, if everybody tries to do this, there's no way it can get done in time. We've already seen the UK extend from 2030 to 2035, saying, okay, well, maybe 2030 was a little much. Let's try 2035. And I think you'll see more countries saying, you know, it's probably not going to happen, and it'll be a major disruption of the consumer if we force it to happen that quickly. Let's look at some other things here. Hertz. Let's get rid of those pop-ups here. Hertz hits the brakes on its EV rollout plan due to unforeseen issue with Tesla models. It's a greater burden. So in here, they're talking about the added cost of maintaining these vehicles. And I think what is telling down here is the Uber part. Part of the problem is an unexpected outcome of an Uber partnership. Half of the 100,000 Teslas, by the way, I didn't do the red with the underlying, that's just part of the story here in case you think that I did that. Half of the 100,000 Teslas acquired by Hertz in 2021 were to be allocated to Uber drivers. While the Teslas are extremely popular with drivers, ride-share vehicles apparently suffer a lot of damage due to higher utilization, and Tesla's high-tech and safety features contribute to their cars being more costly to repair in certain types of accidents. Now, I want you to now think about this whole robo-taxi business and how everyone can just turn their cars into robo-taxis. This paragraph here, I think, has a hint of an unexpected cost that I don't think is being factored in. Part of the problem is an unexpected outcome of an Uber partnership. Rideshare vehicles, down here, rideshare vehicles apparently suffer a lot of damage due to higher utilization. And anybody who has an electronic device of any kind knows that the more technology you put in a device, the more expensive it is to repair. But sometimes when you're buying kitchen appliances, the simplest ones tend to be the easiest ones to maintain. Now, layer in a whole bunch of autonomous driving, a whole bunch of cameras, a whole bunch of LiDAR systems into these robo-taxis, and start sending them around. If Hertz is already seeing this issue with their Teslas that are dedicated towards the rideshare program, well, what is robo-taxi but a major rideshare program? I wonder if those costs were factored in. Let's jump over to Consumer Reports. Electric vehicles, less reliable than gas-powered cars. This is Consumer Reports. You can go to if you click on this new survey, you get to Consumer Reports, and they tell you the size of the sample they use. They use vehicles from 2020 to 2023. 330,000 vehicles were surveyed, and then they looked at problem areas. With internal combustion, there are usually, it says something like 19 problem areas or 17 problem areas. They point the brakes, this, that, a whole bunch of other areas, and then they actually count how many problems there were that actually showed up with the problem area. So a transmission would be a problem area, right? But a car seat wouldn't be a problem area. It's like, well, you know, car seat's a car seat. And then they identified the problem areas you would expect, or where if something would go wrong, here is where it would go wrong on a hybrid and on a BEV. And it says here, while EVs are growing in popularity, owners of electric vehicles experience 79% more problems with their EVs compared to gas-powered cars. And if it's a battery hybrid, not just a hybrid, but a battery, a plug-in hybrid. I shouldn't have said a battery hybrid because all hybrids have a battery. A plug-in hybrid, it was 46% more. Less than a full BEV, but still 46% more problems than an ICE. A hybrid itself had 26% fewer problems than an ICE. Now that's not a plug-in hybrid, that's just a hybrid. And with trucks, EV trucks coming in way at the bottom of the list. But you can probably just Google Consumer Reports, new survey, electric vehicle reliability, and you'll probably find this report. Okay, let's look at forward 4-quarter operating earnings. Another surprise here. It's almost as if the universe is luring you into this big trap because everything seems to be just working out nicely. Forward 4-quarter operating earnings, 236.41 from IBES. Up. Yes, I said it right. Up from 235.82. I don't know when the last time I said that was up. I thought, wow, let's see what S&P Global has. 233.82, up from 233.06. Okay, it's not a lot, but the point is, it's up. This guy's pointing at both, and seriously, look how surprised he looks, right? 19.54 on the forward multiple because, of course, you had a higher close. In fact, you have a close now that is above the July high. SPY had the highest close in July of 457.83. We have a close of 459.82 on the ETF, the index 45.94. You are not a lot above the July high, but the point is it ended the day, it closed above the July high, above the 50, above the 200. There's the 50, there's the 200, above the July high, and let's see where we go from here. And this is sort of promising, is that you actually had from both of these an increase week over week. Again, nothing to really get excited about. The point is, it is the word up and not down. 19.54 versus 19.44 on the forward multiple. Implied volatility increasing simply because, which is usually rare that it increases on the way up, but the move up has been so significant this last week. I think just in the volatility that you had in the big move on Friday, it actually created some implied volatility based on the calls this time. 13-week 8%. Last week there was no implied volatility. Now you're getting some. And it's rare at the level of an index that you get implied volatility increasing on the way up. It's more common at the stock level, but it can happen if you have a lot of call buying. And I think last week probably represented the safer way to buy this market is to say, is this a big trap the universe is setting for me? If it is, let me minimize my downside. While implied volatility is non-existent, let me buy some calls. That was probably the cheapest way to participate in a rally, perhaps. That might be a head fake. Who knows? But here we are. So you have two central bankers, two specific ones last week. Powell being the most significant with his language about inflation. And then you had Waller talking about, and Waller's been talking about this for a while, that it may be necessary, not just appropriate, but necessary for the Fed to cut rates next year as inflation comes down. Otherwise, real rates would be increasing, and that would actually be extra tightening, of which the central bank doesn't want to do. So if they're going to look at real rates and target real rates, as inflation comes down, they may have to cut the nominal rate to keep the real rate from getting overly restrictive. That set up a little party earlier in the week on the SPY. And then Powell's comments, I seem to remember checking in just a little bit before I left on Friday, and the market was kind of, it was the 1st of December, and I think the November party was over, and it was like, But when I came back at the end of the day, it was like, whoa, something happened. So I had to listen to Powell's fireside chat at Spelman College. And if I had to bring it down to something, it was the way he described inflation. And there it is. The rest is history. A great week for duration, an okay week for beta. I mean, overall, the market wasn't up that much. But it was huge in the fact that it above the July close, that it closed above the July close. So it is the high of the year. We are at, like, this is where is the beginning of January. January is up here. So if you look at what happened into July, maybe not so. Hang on, maybe it will. And then the close above that, you're at the highest point for the year. Even though it's only up 0.33 on the week, it's a big week for SPY. In the earnings calendar this week, there isn't much. I think Campbell's Soup is this week, and I think there are two others of significance that I looked at. So, a Dollar General, I think, is this week. Campbell's Soup, and there was another one that I thought, oh, that was interesting. But I think there's only like 6 companies reporting this week. The big thing is jobs this week. Next week, we get CPI, PPI, and the Fed. PPI at 8:30 in the morning, the Fed at 2. So after they probably move zero, there's really nothing between here and the end of the year. And if the data this week, especially unit labor costs, if those are negative, I think that you could probably push higher on the S&P. Well, there it is. There's my first broadcast from the tropical nation of Costa Rica with this room with a big echo, which I guess I can fix by just hanging stuff on the walls, but it's this big row of windows I don't know what to do with. You know, sound just bounces off those windows. And then that whirring sound in the corner, it's just this big panel of electrics, because everything in this house runs off an app. I mean, everything runs off an app. It's absolutely amazing. Next week, I'll post some pictures of my view outside the office that I have of the window, and yeah, I'll share my time with you on that. That's it for this week.